Happy Friday. Brian Manny here with a weekly update. Oh, and happy President's Day weekend. Hope everybody gets a day off on Monday. If your kids are in school, you get 2 days off this weekend. So I hope everybody has a great holiday weekend. Let's talk about what happened this week. Monday, relatively quiet news day. Not a lot to talk about there, but Tuesday, things got heated. So Tuesday, we got the CPI report. That stands for the Consumer Price Index. This is a gauge of inflation. It's not the Federal Reserve's favorite gauge of inflation, but it is a gauge of inflation of it's one of two reports that comes out. So there's a lot of weight that goes into it. We got the CPI report. So on a month-over-month basis, the headline number was up 0.3%, and on a year-over-year basis, you had inflation come in at 3.1%, down from 3.4. This was definitely a miss. Market expectations was this number would be around 2.9%. Then we got the core rate on a month-over-month basis. The core rate was going up 0.4%. This was a miss as well because it came back unchanged. But let's really look at, probably what's most impactful and why this report was unchanged or just a miss as far as expectations were concerned. So in the report here, 45% of this is made up of shelter costs. And of the 45%, 33% of that is made up of what's called owner's equivalent of rent. So that's like someone calling you and saying, hey, if you were going to rent your house today, how much would you rent your house for? And let's just say you say $3,000 a month. And then they called you the prior month and they said, hey, if you're going to rent your house last month, how much would you rent your house for? And last month you said $2,800. It's not really factual information. It's owner's equivalent of rent. It's really how much you think you could rent your house for based on the market that you're in. But that number in here, 33% of the inflation data, is a really large driver in the inflationary numbers. And we also had motor vehicle insurance. So on an annual basis, motor vehicle insurance is up 20.6%. On a year-over-year basis, up 1.4%. Whatever the Federal Reserve does, no matter how much they hike interest rates, they're never going to have an impact on motor vehicle insurance between damage to cars from natural reasons, hail, etc. Also just damage from theft, accidents, etc. No matter what you do, you can raise rates as much as you want. That's never going to change motor vehicle insurance. And that was also very impactful in the report as well. We'll have to wait and see how PCE comes out, but the markets did not like this report on Tuesday. And that kind of led us to Wednesday. So Wednesday, we had Austin Goolsbee come out. He's the Federal Reserve president in Chicago. And he came out and he just said, hey, everybody calm down. I know you're seeing the CPI report, but the Federal Reserve, we're not focused on the CPI report. We're mostly focused on PCE. PCE doesn't carry as much weighting for the shelter number, so we have to wait and see what happens there. He also said the Federal Reserve is not going to wait until inflation hits 2% to start cutting rates. They're going to start cutting rates before that. And he said, there's going to be some blips in the process. You're likely not going to see a straight line of inflation moving lower. And he definitely calmed the markets down on Wednesday, but we'll talk more about that in a second. Also on Wednesday, we got Zillow Home Buying Index. This is for the month of January. It said the average days on market for homes was 29 days. Also, 26% of homes, sold above the list price, and inventory is only up 1.5% in the month of December. This is really important because inventory is still 40% below pre-pandemic levels. So everyone that's been worried about a housing bubble, if you just look at the continual imbalance of supply and demand and inventory being 40% lower than pre-pandemic levels, we're just not seeing that. Thursday this week, we got retail sales. So retail sales were expected to be down 0.1%, but they were actually down 0.8%. This is for the month of January. Retail sales in the month of December were really hot, so this definitely calmed the markets down because consumer spending slowed in the month of January. But then today, we get the PPI report. So PPI stands for Producer Price Index. This measures inflation at the wholesale level. This report was stronger than expected, and the markets aren't really loving that today. But December was revised lower, so there's a little bit of a balancing out there. But if we look at this, what was really the culprit of the PPI report going up? Part of it was services. The second part was outpatient hospital. The third was portfolio management. So let's just say you did really well in the stock market last year and you're a financial planner and you look at this and saying, hey, my clients did really well. S&P was up strong and I can raise my fees this year. So that could be part of it. And then legal services. So we'll have to wait and see what happens. PPI does play into the PCE report. That's the Federal Reserve looks at most importantly for inflation. So I'll have to wait and see what happens there. But just market's not loving that today. I'm around all weekend. If you have any questions, let me know. If you want to learn how we're closing purchase transactions in 10 days, give me a call. I'd love to help you. Happy Friday. Happy President's Weekend. Hope you have a great day. We'll talk with you soon.